Today we're going to dive into the tax differences between three major accounts used today for retirement income. And that would be the 401k, the Roth 401k, and the IUL. We're going to dive into how each account works, how taxes impact you today and later on in retirement, so you can make the most informed decision on which strategy makes sense for you. And at the end, I will show you some real numbers so you can actually see how this works. Let's dive in. First, you need to choose your stance on taxes in the future because your thoughts on this will determine which type of account is best suited for you. Do you think taxes will be higher or lower in the future? Let's take a look at the facts. If you take a look at this chart from taxpolicycenter.org, you will see that the highest the federal tax bracket rate has ever been was back in 1944 and 1955 when it was at a whopping 94%. That was back during World War II. Since then, taxes have slowly been on the decline, and it took about 43 years to get them down to the lowest we've seen in modern day history, which was 28% back in 1988. And then since then, they've been slowly on the increase, but due to the introduction of the TCJA Act in 2017-2018, you notice the taxes took a little bit of a cut. But that act is actually set to expire in December of 2025. Now, how will taxes be impacted if the TCJA Act does in fact expire without renewal? Well, according to taxfoundation.org, the TCJA retained the 7-bracket structure for individual income tax, but lowered 5 of the 7 rates and adjusted the widths of the brackets. If you take a look at this chart from taxfoundation.org, it shows their projected expected increase per bracket if the TCJA Act does expire. Keep in mind, tax brackets are marginalized, which means that all of your income doesn't get taxed at the highest rate. It's going to get taxed in certain brackets based on where it falls. So if you take a look at these two graphs, this will show the width change of each bracket if the TCJA Act were to expire based on projections by taxfoundation.org. You'll notice that we have it up here for individual and for joint filers. And the income that you see in the range of the bracket, that's how much of your income that you make between those two numbers will get taxed at that rate. We also have to take into consideration that our country is currently $36 trillion with a T, trillion dollars in debt and counting. And programs like Social Security, Medicare, and Medicaid are drastically underfunded. These are things that we definitely need to take into consideration on our thoughts on taxes in the future. That all being said, do you think taxes really have a chance of going down in the future? Now, you may have been told by somebody older than you that you're going to retire in a lower tax bracket. And for individuals retiring today, that actually was true. The baby boomer generation were born between the years of 1946 and 1964. So if we go back to this chart from taxpolicycenter.org, you will notice most of those baby boomers didn't start working until the 1970s and the 1980s. And that was a time when taxes were at an all-time high. Since then, the brackets have gone down drastically for these baby boomers. So yes, they did in fact retire in a lower tax bracket. But with everything that we just discussed, what's going on with our economy and how much debt our country is in and counting, if all of the tax brackets go up in the future, how could you possibly retire in a lower tax bracket? Now that's the facts. It's up to you to decide what you think will happen to taxes in the future. Now we're going to dive into how these 3 different accounts get taxed when it comes to pulling income out. We're going to look at the traditional 401k, the Roth 401k, and the IUL. First, let's start with traditional 401ks. The money that goes into your traditional 401k comes off the top of your paycheck, which means you haven't paid taxes on it yet. It's going to grow tax deferred. So what that does is it gives you the ability to get a tax reduction today, potentially because you are not paying taxes on that money today. You are deferring paying taxes on that later when you go to retire. And when you take that money out as income in retirement, you are taxed on it as ordinary income. You also have to follow what's called the RMD rule, which currently is at age 73, which means you have to start withdrawing a percentage of that account by the time you turn age 73. If you don't, as of today, you'll be suffering a 25% federal penalty on anything you do not take out for an RMD. Now, Roth 401ks work a little differently. The money doesn't come off the top of your paycheck, it actually comes from the bottom of your paycheck, which means that you've already paid taxes on this money, so it can go into your Roth 401k already taxed after tax dollars, which means you get no tax reduction today for doing that. But that money can grow and compound for you tax-free. So in retirement, when you start to pull money out, that money's already been taxed. So the money you put in plus the interest you earned will come out to you in retirement completely tax-free. And because of that, you do not need to follow the RMD rule. Because of the fact taxes have already been paid, there is no restriction on when you have to access your money. And IULs actually work very similar, except most of the time the money is not coming out of your paycheck. Typically, it's coming out of your bank account and then getting deposited into an IUL. But the money that's coming out of your bank account has also already been taxed, right? It's after-tax dollars that are typically sitting in your bank account. So that money doesn't, again, give you a tax reduction today because you've already paid taxes, but that does allow your money to grow and compound tax-free, right? Accessible to you in the future, all tax-free. So when you're taking income out at retirement, you're in the 0% tax bracket. And you guessed it, IULs also do not have to follow the RMD rule. And in fact, they also don't have to follow the age 59.5 rule, which is a rule both the traditional and the Roth 401k have to follow. So you get a little bit more flexibility with an IUL, but it does have to be after-tax dollars going in so you can access what you put in plus your interest, all tax-free. Now let's see how these accounts stack up against each other with a real-life example so you can see how the taxes work. Let's assume that we are a 30-year-old male and we are going to put $1,000 a month of after-tax dollars into our Roth 401k and our IUL, which would mean if we were doing the traditional 401k, it would be $1,330 pre-tax money going into that account per month. Let's assume we do this until retirement and we're earning an average 6% rate of return through all years, our accumulation years and our income years inside this account. Now, obviously, there could be some years where that could be higher. There could be some years where that could be lower. We're going with an average 6%. That would mean that in your traditional 401k, you are estimated to have a balance at retirement of $1,885,000 pre-tax. With your Roth 401k, you're estimated to have $1,420,000. And with your IUL, you're estimated to have $1,300,000 inside that account. Now, we have to assume that we are going to start taking income out of these accounts in retirement. So the estimated pre-tax annual income you could expect to receive from your 401k would be $127,400 a year in retirement. With your Roth 401k would be about $95,700 a year. And with your IUL, you would be looking at about $108,000 every single year in retirement. But we also have to subtract out taxes because with the traditional 401k, we haven't paid them yet, right? So if we're just assuming an average 25% bracket, that's not factoring in that taxes could go up in the future, you'd be looking at paying about $31,800 every single year in taxes. Now let's see what this would get us in an estimated income stream in retirement net of costs and fees. We're going to assume a 1% fee per year for the investment accounts when it's typically much higher than this, but we're going to be very gracious and just go with 1%. And in the IUL, the fee is really just a cost of insurance that's already been deducted. But in the traditional 401k, you'd be looking at about $95,500 a year. In the Roth 401k, you'd be looking at about $95,700 a year. And in the IUL, you'd be looking at about $108,000 a year after taxes, after costs, net income to your bank account. Which one looks better? Now, of course, these numbers could look very different depending on your age, depending on if you're older or if you're younger. It's just important to sit down and do out the calculations so you can see which one's really going to make the most sense for you. So how do you really determine which account is best? Well, if you're on the side that you think taxes could go down in the future or that you might retire in a lower tax bracket and you're okay with some market volatility, a traditional 401k might make sense for you. If you think taxes might go up in the future and you're okay with some stock market volatility inside of your account, you just want to make sure that you retire tax-free, a Roth 401k might make more sense. And if you're looking for a more flexible way to save for your future, where the money will grow and compound tax-free because you think taxes are going to be higher, you don't want the stock market volatility, and you want a little bit more freedom in how you access your money, and you like the benefit of the life insurance, an IUL might make more sense. Now keep in mind, today's video is not meant to be taken as investment advice. The answer to your question on which account should I choose is going to be dependent on you and your unique financial situation. Do you think taxes are going to go up in the future? And how important is tax-free income to you in retirement? I want to encourage you to get with a licensed financial professional where you live that you trust that can help navigate you through these decisions. If you'd like to work with me or my team, you can click the link in my bio or in the description below to get access to our calendar to schedule a complimentary conversation with us. And if you like this video, make sure to give it a thumbs up, hit that subscribe button, and click the bell to turn on notifications so that you can get notified when my next video comes out because I wouldn't want you to miss it. Please share this video with anyone you can think of that can benefit from this information, and I look forward to seeing you back here next week on YouTube.